Ever wondered how the stock market works? Well, let's start with the basics. Stocks. Stocks, also known as shares or equities, are essentially small pieces of ownership in a public company. When you buy a stock, you're buying a tiny fraction of that company. But how do these shares get into the hands of the public? That's where the journey begins. Companies can decide to go public, meaning they offer a portion of their shares to the public. This is done through a process called an initial public offering or IPO, or sometimes through a direct listing. It's like a company's big debut on the financial stage, and it's the moment when you, as an investor, can start buying these shares on the stock market. These shares are then traded, bought, and sold on the stock market. So in essence, buying a stock means buying a piece of a company. But what exactly is an initial public offering, or IPO? Picture a company deciding to step into the limelight of the public stock market. To do this, it partners with an investment bank to orchestrate the IPO process. Think of the investment bank as the company's director, guiding it through the complexities of becoming a public entity. In its big debut, the company presents a portion of its shares to the public, like an actor unveiling a captivating performance. These shares are like tickets to the show, and investors can purchase them at a price determined by the company and its directors, the underwriters. It's a pivotal moment for the company, as it transitions from a private entity to a public one, opening its doors to public investors for the first time. It's an intricate dance, with the company and its underwriters fine-tuning every detail to ensure a successful performance. An IPO is essentially a company's debut on the stock market stage. Once the shares are out there, where do they go, you might ask? Well, they dive into two distinct arenas known as the primary and secondary markets. In the primary market, the interaction happens directly between the company and the investors. This is where the initial public offering, or IPO, comes into play. The company offers a portion of its shares to the public for the first time, setting the stage for investors to buy in. But once the IPO is done and dusted, the action shifts to the secondary market. This is where all the trading post-IPO happens. Unlike the primary market, the company is not directly involved in these transactions. Instead, investors trade shares among themselves on various exchanges, such as the New York Stock Exchange or NASDAQ. So, in essence, the primary market is the birthplace of new shares, while the secondary market is more like a bustling marketplace where these shares find new owners. Think of the secondary market as a marketplace for investors to trade among themselves. Ever wondered why stock prices go up and down? It's all a matter of supply and demand. Picture this. When demand for a certain stock is high and there aren't enough shares to go around, the price naturally goes up. It's just like when a hot new gadget hits the market and everyone wants one. The price can skyrocket because there simply aren't enough to meet the demand. On the flip side, when there's a large supply of a certain stock and not enough investors are interested in buying it, the price drops. This is similar to what happens when a store has too much of an item that isn't selling. They'll likely slash the price to encourage people to buy. So, when you see stock prices fluctuating, remember it's a result of this tug-of-war between supply and demand. The price of a stock is essentially a real-time reflection of what people think that company is worth. So, stock prices are a constant dance between supply and demand. So, how do investors make money from stocks? That's a question on many minds. Well, there are two primary ways that investors can profit from stocks, through dividends and stock growth. Let's start with dividends. These are essentially cash payments that a company distributes to its shareholders, usually on a regular basis. Companies that have a steady stream of income, like those in stable, mature industries, often pay dividends. It's like a thank you note to shareholders for their investment. Then we have stock growth. This refers to the appreciation of the stock's value over time. When you purchase a stock at a certain price and its value increases over time, the difference between the purchase price and the current price is your profit. This is why some investors focus on companies in fast-growing industries. In both cases, the key is to understand the company and the market it operates in. Whether through dividends or stock growth, savvy investors find ways to make their money work for them in the stock market.